Hello, you. Welcome back. Let's talk executing trades, right? In this episode, we're not learning new strategies, we're connecting the pieces broker, charting, and the contract itself. So you can see how a real trade is placed from start to finish. The broker, your market access point. Think of a broker as a specialized financial bank for trading. Just like a bank holds your money and processes your payments, a broker holds your trading capital and processes your trades. Your broker holds your deposited funds. It connects you to the market. It executes your trades instantly when you click buy or sell. Now, this is important. Not all brokers are the same. In order to trade options, you need what we call a level 2 options account, sometimes called an options approval. So, whatever broker you use, I use Webull and Interactive Brokers. You use Charles Schwab, you use Fidelity, you use Mumu, which I know nothing about. Just ensure that you are able to trade options with that account. There's going to be a little test that they make you write so that they can see that you know some about options. Then you're going to get an options approval account so that you are able to trade the options market. This means that the broker has approved you for options trading. You can buy calls and buy puts. You are trading with defined risk. We're not talking complex strategies like spreads or covered calls or iron condos here. We just want to be able to trade directions like Forex. We read the chart, you decide if it's up or down, and then you enter into call or put. That's basically the order. The broker is just the tool that allows this to happen. The thinking happens before you log on. All right. So that's what the broker does. It's where your trades are placed, holds your funds, and where you do your execution. All right. Now, what is TradingView? It's a charting platform, right? It's not a broker. I know some brokers are able to connect to TradingView for when you trade Forex and other, I think, futures and other things like that. But I've not seen an options trader who trades directly on TradingView. If you feel like you want to, you just find out if your broker can connect to TradingView. But we use TradingView to chart and analyze. So I do not place trades on TradingView. It's where we study the market, where you analyze. Think of it like as your analysis workspace, your planning desk, where your decisions are made before money is involved. On TradingView, you look at price movement, we identify trends, we mark support and resistance, we decide if the market is going up or down or sideways, which you want to stay away from. We never want to trade on a sideways market. TradingView has a free version, which I've been using for the past year. It's more than enough. And obviously, there are paid versions, which are optional, not required. You don't need fancy indicators or paid tools to trade well, especially when you begin. Most profitable traders keep their charts very simple. We don't like noise because noise causes confusion in my opinion. All right? We analyze here first, then we go to execute at a broker. All right, so it's charting space, not a trading space. We analyze, we draw levels, and then we make our decision. Then we go to the broker when we're ready to buy a contract. Here, from chart to contract. Once we have directional bias, bearish or bullish, the next decision is to choose a contract. So in options, we speak about in the money, at the money, and out of the money, right? These don't change the direction. They change they change risk, cost, and sensitivity. So here's an example that I don't want to get deep into. Here we picked up a call, so we pretending as if we are buying a call contract. Again, I went to my paper trading account. So 0D, I opened 0D, I made 0D to uncollapse, right? And you can see up there the first three rows. So 698, 697, 696, those are strike prices that you're trying to buy. And then you get that ITM that's almost like red in the middle. Then you get 696, 695, 694, 693. ITM means the strike, it's in the money. What does that in the money mean? It means that the strike price that you're trying to buy a call contract for has already been achieved. it has an intrinsic value. So the direction that you are trying to move has been achieved, and the strike price 693, 694, 695 have been achieved. There is value. Why is it expensive? Because there's value. Can you see there? Even the one in the first row of 695 strike price is $2.84 versus the strike price of 693. It's $4.19. Why is 693 expensive? Because 693 strike price has already been achieved. There is value. As soon as you buy that contract, you're going to be making profits immediately because that has been achieved, right? Hope that makes sense. And then the further you go out of the money, the less expensive it is because you still believe in the direction. It's not been achieved yet, but you believe. So again, there's no right or wrong here. You decide what works for you and how much, how sensitive you are to cost. I'm not going to speak to the Greeks, the implied volume and the deltas, because that's not what this video is about. All I wanted you to understand is that in the money, there's intrinsic value. There's value already in the contract that you want to buy, hence it's going to be expensive. Out of the money, there is no value yet. So you want to buy there, you believe that the direction is strong, then it's going to gain value while you're there. So that's how it is. Okay. And then at the money is basically if the strike price is around 695.42. So I usually go one at the money. So in this example, I would buy the 696 or maybe even the 697, the 170, the $1.70, because maybe I know that I know volume is going to increase and the direction is strong. I've charted and I believe that this is the direction it's going to. Then I make money on top. It's cheaper for me, and then the direction is going to gain value, right? And another thing that I just wanted to clarify and highlight is that $1.70, $2.23, $1.24 that you see there, you're going to times it by 100, because when the options change, which is what this is, when the options change, they only list the price at 1/100th, right? They listed in a fraction of 1/100th. So what you see there, that $1.70, you times it by 100, so it's going to be $170. That $2.23 is going to be $223. So you need to have $223 or $170 or $124, or if you're buying the 693 strike price, $419 in your account, you'd be able to get into the contract. Contracts are sold in bundles of 100. That's all I just want to clarify. So again, in the money is more expensive because it moves closer to the stock and is less sensitive to time. You already achieved the intrinsic value. At the money, it's balanced. It's most responsive to the price movement. Out of the money, it's cheaper because it's higher risk. Why is it higher risk? We need a stronger move to get to the direction in order for us to get the value. There's no best, it only fits what your account size is and what your strategy is. That's just all we need to clarify.
Now let's talk about entering and exiting a trade. I've got my Webull app on my phone. I prefer it on my phone. I've never tried the desktop version. On my phone, for easy access when I want to enter and exit a trade, there's my Webull app. Now when we press that app, it's going to take us to this sort of interface. And then for the purpose of this video, I'm going to speak to my paper trading account so that you can see how you would enter and exit. So the interface would look like that. A lot of things going on. So I would, at this point, press paper trading. Paper trade there on the top. When I've pressed paper trading, you can see here's my paper trader account. I am currently in a trade. I'm practicing my swing trading strategy. So swing trading where I'm in a trade for a couple of days. I bought this Apple call 2 days ago. You can see it expires on the 30th of January. So I'm in the middle of a trade currently. So after you've pressed options, because you want to get into options, you want to buy a call or buy a put. This is what it would look like. Here I've pressed both, so you can see calls and puts at the same time. There's 0D, 1D, 4D, 5D. Those are the dates to expiry. Are you buying? What type of contract are you buying? Are you buying in the money? Are you buying out of the money? There are different prices for in the money, out of the money, and all of those things, right? We've discussed it earlier. So you decide if you're buying a 1-day contract, a 4-day contract, and are you going in the money or out of the money? due to what strike price you're trying to buy. So there you can see in the middle, the strike prices are varying. Do you believe the price is going to go to 695 or etc., etc.? So you have made your decision, you've worked out your probabilities, you have looked at your charts. You are saying, I'm buying a 0D contract and I'm buying it in the money, and I'm buying a call, or am I buying a put? But again, I want us to show you, for the purpose of this video, I never go to both. I press call if I want to buy a call. I press put if I want to buy a put. It's easier for me to see. I don't like seeing all those puts and calls at the same interface. Here I pressed a call, and you can see that we're still on the SPY ticker. Now it's easier for me to see what's in the money, what's out of the money. And if I'm buying a 0 DTE contract or 1 DTE contract, I've opened 0 DTE here. So you can see that ITM means this contract is in the money. What did we say what in the money was? The strike price has already been reached. So the contract, the stock price has already hit 693. Obviously, it's going to be expensive because you're buying something that has an intrinsic value. So it's going to be expensive. And then the out of the money ones up there, they're less expensive because they haven't hit that stock price. But you have a high, after your calculations and your charting, you believe that it will hit. So that's why it's going to be less expensive. Well, I'm not going to speak to the deltas, the implied volumes, and all of those things at the moment, because those are Greeks that we're not talking to on this video. I just wanted to show you the interface of what it would look like when you are on Webull and you want to purchase a contract. Now that you've pressed the in the money, out of the money, whatever, you're going to come to this interface, and then you must press market. It's easier for you to get into a trade when you press market, because it's if you press limit, the order type, it's going to take long and the trade is going to miss you. So market, I chose one contract, and then you press options trading. Now it's going to look like this. Your position is going to sit like that, like the current open trade. It's going to sit like that. It says my positions are that Apple trade that is sitting there currently. All right. So it sits like that when you bought the contract, right? Now, when you want to exit, you press that contract that was in my position. Now you're like, okay, I'm ready to sell this contract. I'm done. I've made too much loss, or I've made my profit. I'm happy with it. You press the contract, and then after that, you go into this button at the bottom that says sell to close. I used to wonder, I've entered my position. What do you do? So you buy the contract at the beginning, and then you sell to close it, and that's it.
So keep it simple. Analyze on TradingView, execute on your broker, choose contracts intentionally, manage risk, and profits will come. Complexity comes later, clarity comes first. See you next time. Take it easy.